Great question, because we've only heard about the Warsh nomination just a week ago, and the market's been extremely volatile. I think there was some knee-jerk reaction. I mean, he's highly qualified, but it is a committee. He's been very critical about Fed policy for the last 15 years. He's going to have to build consensus. So did we change portfolio positioning because of Warsh? No. We are going to watch the data.
But is it a Warsh-affected market? I mean, the fact is, it's a world turned upside down for a lot of people.
Right. I think the market, at least on Friday, looked at the front end and said, oh, Warsh might be more open to cutting rates because he's in the supply side, pickup in productivity. The long end got a little nervous. And that I would strongly push back against. I know he's been critical of the balance sheet expansion and QE by the Fed, but a lot of that QE is to provide reserves to the banking system. And the Fed understands it. I think if Warsh comes in, he's going to look at the analysis and actually not be able to cut the balance sheet. I don't think he has votes on the committee. So if the market got nervous about the unwind of the Fed balance sheet, I think that we can fade. There are other issues this week. Is the AI capex too much, which last year everyone wanted AI capex, and now they're saying this might be too much of a good thing. And then is there displacement in the software sector? So I think the fears have morphed. We've dealt with a lot this year.
And just in the equity markets, concern about the capex, as you mentioned. We had Rob Schiffman in yesterday. He covers the TMT space from a credit perspective for Bloomberg Intelligence. He says the bond market's fine with this capex, and the bond market's taken all the paper that's coming out. The spreads remain tight on all these deals. So the bond market's saying we're okay with this capex, but the equity market's not so sure.
Right. So I think a lot will depend. If it's $650 billion, how much is financed in the bond market? We saw this with Oracle. Yep. They actually came in with much lower than that 50 billion number, and the books were very well subscribed. But I'm glad you talk about, because credit spreads are looking at fundamentals. The fundamentals of the companies that are doing the AI capex are very solid. Mm-hmm. All the software companies, which were all the news this week, you look at the high level of subscriptions, high margins. But I think the question is how much of displacement versus disruption is going to happen with AI. What are their earnings? But I think we look at fundamentals of earnings, of leverage ratio, and I think that's why these spreads are where they are. And I think yesterday showed you that fixed income does provide you that ballast to portfolios. And that's why you saw rates fall. And so actually, if I want to be somewhere which is safer, maybe the bonds of those companies might be the safe place.
Oh, listen to her selling bonds. She's taking a Kool-Aid from Bob Michael. There's no question about it. Priya Misra, JPMorgan with us. Their great lineup this morning. We welcome all of you. 99.1 FM, snack-bound Nathan Hager getting ready for the Super Bowl. Good morning, 99 FM. If you can focus this morning in Bloomberg 1130 in New York, across the nation, major shout-out. Sirius XM, Channel 121, across Canada, and across all of America. We really appreciate your support this morning. Let's get back to full faith and credit, Priya Misra, right now. The first thing I did this morning, I walked in because you told me one day, hey, stupid, look at the 5-year as compared to the 30-year bond. It's buttressed up against resistance, translated in the question, what happens if these spreads break out to new steepness? What does that signal?
The spreads, the credit spreads or the curve?
The curve, excuse me.
So if the curve does steepen, that's a sign.
See, I just got a C- with Priya there.
No, there's a lot of spreads we spend all day looking at. If the yield curve steepens a lot, I think you should pay attention to that, because that's telling you that the economy might be slower or weaker. We may be transitioning from a low fire, low higher to a high fire, low higher. And I think without payrolls, it's really hard. But we did see some data this week that made the market a little nervous about the job market. I mean, we know there's low hiring. If the firing starts to pick up, then the Fed is cutting a lot more than what is priced in. We're currently only pricing in 2 rate cuts this year. So that front end, if the curve steepens because the front end rates fall, that's a sign that the job market is much weaker. The Fed will absolutely respond, but I would get more nervous about the economy.
Paul, that's what we're doing. We're just sitting around waiting for the labor economy to decide what to do.
Yeah, and I don't know. I mean, there are some concerns out there, but boy, the headline numbers still look pretty decent here. In the fixed income space here, I see a lot of green on my screen here on year-to-date performance here, following up a strong 2025. Where is value in the credits? I mean, how much credit risk are you taking versus just sitting on a 2-year or 10-year treasury bill?
So we are taking credit risk because we think the economy, to your earlier point, there's a lot of cross currents. There's always risks. But the economy looks to be in a strong position. You look at private sector balance sheets, whether it's the consumer side or the corporate side, the fundamentals are very strong. And so we like credit risk, diversified, high quality. We haven't really gone down to the triple C part of the market. Spreads are so tight that they're not giving you cushion for if things get worse. But I think whether it's investment grade corporate, even high quality, high yield is very attractive in our mind, double B, even some single B, staying away from loans given the software exposure. But, whether it's securitized credit, mortgage spreads, we loved that a year ago. They've tightened a lot. We're not going underweight, but we're not adding to mortgages here. Securitized credit. So I think you should own some diversified, high quality credit. Just buy some treasuries as well as a hedge if the economy slows down.
Unfair. It's off your remit, but I'll go there because you're just so damn good at this. The basic idea of everyone is Oracle did X billions of dollars of paper. What do you presume after the first, the second, the third company puts out billions of dollars of paper? Is the market there to pick it up, or does it sit on Bob Michael's desk?
So I think a lot depends on spreads. So if there's a lot of supply, we expect spreads to widen, and then it might look attractive. Given the demand and the books, the demand inflows, I think we're talking 10, 15 basis points. But I would watch for what are they spending the money on? Are they spending it on productive uses? I mean, these are the big questions we're going to grapple with all year. And what is the use case? Is it, are we still waiting for that use case, or are these companies putting money in and the rest of corporate America is using it? I think that's, if that happens, I don't think you'll see much widening in spreads. But I'm hoping that all these CEOs are listening to the discipline of the market. So you have to be careful about how you fund and where you invest this money.
Seahawks or Patriots?
I'm a Pats fan. But I would say they're both great.
I apologize here for that.
They're both great teams. I'll be watching that along with the Japanese election, but hopefully.
Oh, you like on a halftime, you're not going to watch Bad Bunny, you're going to look at the Japanese election?
I will be. Well, fortunately, it's a different time zone, so it'll be a long day, but it should be fun.